If you have a mortgage, I need you to stop what you are doing and listen to this carefully. Not because something might happen, because something already has. A decision was made inside a Senate hearing room in April that will directly affect the real value of every fixed-rate mortgage in this country over the next decade. It was not reported by CNN. It was not covered by CNBC. The Wall Street Journal ran a single paragraph and got the meaning exactly backwards. And the mechanism behind that decision, the specific legal and monetary framework that was just activated, has not been used in this country since 1974. The last time it ran, it erased roughly 2/3 of the federal government's debt, not by paying it down, by quietly making the dollars used to repay it worth less than the dollars originally borrowed. That framework is back. And if you have a mortgage at any fixed rate below 5.5%, the next 10 years are going to do something to your financial position that no financial advisor has called you to explain. Here is what most people do not understand about how the Federal Reserve actually works. The Fed does not just set interest rates. It manages the relationship between the interest rate your bank pays you and the rate at which your purchasing power declines. Those two numbers are almost never the same, and the gap between them, which direction that gap runs and by how much, is not an accident. It is a policy choice. It can be engineered deliberately. It has been engineered deliberately before. And the name for the policy framework that does this on purpose, that intentionally keeps the rate on your savings account below the rate at which prices rise, so that savers slowly lose ground while debtors slowly gain it. That framework has a name that has not appeared in any official Federal Reserve document in over 40 years. Until April of this year, when the incoming Federal Reserve Chairman used it twice in his prepared Senate testimony. The phrase is financial repression. Most people hear that term and assume it refers to something illegal, something hidden, something that happens in unstable economies. It does not. Financial repression is a documented, published, academically studied monetary policy tool used by sovereign governments to reduce their debt burden without formally defaulting. The International Monetary Fund has written extensively about it. The Bank for International Settlements published a 47-page analysis in October of 2025 on its likely return. Economists at the Bank of England and the Center for Economic Policy Research have each published papers in the last 18 months anticipating exactly the sequence of steps that were just described in Senate testimony. This is not a conspiracy. It is a mechanism. It is a tool. And it is now being picked up again by the most powerful financial institution in the world. Now here is where most people make the mistake that will cost them. When they hear the words financial repression, they immediately think about inflation. They think about the price of groceries, the cost of gasoline, the heating bill. And yes, inflation is part of the mechanism. But the real danger is not the inflation itself. The real danger is what you do in response to it. Because the instinct that every responsible American has been trained to follow, pay down your debt, build your savings, hold conservative investments, that instinct is precisely what the framework is designed to exploit. The people who follow that instinct under financial repression are the ones who fund the debt reduction. They are not protected by their caution. Their caution is the mechanism. Think about what that actually means for a moment. It means the family that has been dutifully making extra principal payments on their mortgage every single month, trying to own their home free and clear by retirement, is voluntarily accelerating a transfer of their own purchasing power back to the institution that holds their note. It means the retiree who moved everything into a high-yield savings account because she wanted safety is sitting in the exact instrument the framework targets first. It means the husband and wife who did everything right, paid off the credit cards, built the emergency fund, kept the portfolio conservative, are positioned by design on the losing side of the largest debt reduction mechanism the federal government has deployed in half a century. I want to tell you about a man named Gerald. He is 64 years old. He lives outside of Tulsa, Oklahoma. He spent 31 years as a shift supervisor at a natural gas processing facility, retired with a modest pension, and refinanced his home in 2020 to a 30-year fixed rate of 3.1%. For the last 3 years, Gerald has been making an extra $300 payment toward his principal every single month. His financial advisor told him it was the smartest thing he could do at his age. Gerald called my office in early May because he had read something online about the new Fed chairman, and something felt wrong to him. He could not explain exactly what, but he was right to call. Because what Gerald has been doing for the last 3 years, that $300 a month, every single dollar of it has been a mistake. Not because Gerald is careless, not because Gerald is uninformed. Gerald is exactly the kind of person who reads the fine print, who calls his bank when something looks off, who has never missed a payment in 31 years. The mistake Gerald is making is not a character flaw. It is a timing problem. The rules of the game changed in April, and nobody called Gerald to tell him. Here is what is actually happening to that $300 every month. Gerald's mortgage rate is 3.1%. If inflation runs at 5% over the next decade, which is the policy target implied by the framework now being implemented, the real cost of Gerald's remaining mortgage debt is shrinking by roughly 1.9% every single year, without him doing anything at all. The debt is being inflated away. The federal mechanism is doing the work for him. Every extra dollar Gerald sends to his lender is a dollar he is paying at today's purchasing power to retire a debt that will be worth less in real terms next year than it is right now. He is paying full price for something that is already on sale and getting cheaper every month. Gerald is not alone. I want to tell you about Sandra. She is 71 years old, lives in a suburb of Memphis, Tennessee, and spent her entire working life as a licensed practical nurse. When she retired in 2021, her financial advisor helped her build what he called a conservative, income-generating portfolio. Approximately $180,000 in long-duration treasury bonds, with maturities ranging from 15 to 30 years. Sandra receives coupon payments twice a year and she has never touched the principal. She believes she is protected. She is not. Long-duration bonds are the single most damaged asset class under financial repression, and the damage works in two directions simultaneously. The coupon payments Sandra receives every 6 months buy fewer groceries, cover less of her electric bill, and stretch further toward nothing with every passing year, as prices rise faster than her fixed payment. And if Sandra ever needs to sell those bonds before maturity, if a medical expense comes up, if the roof needs replacing, if anything interrupts the plan, the market price of those bonds in a rising inflation environment will be lower than what she paid for them. Sandra is losing on the income side and losing on the principal side at the same time, and her quarterly statement shows a number that has not changed, so she has no way of seeing it. The pattern I see across hundreds of cases every year is not stupidity, it is lag. The advice that protected retirees in the 1980s and 1990s, hold bonds, pay off debt, keep cash liquid, was correct for the framework that existed then. Paul Volcker ran the opposite policy. He crushed inflation, pushed real rates positive, and made savers the structural winners for an entire generation. Every financial advisor who trained during that era, every retirement guidebook written between 1985 and 2015, every conventional piece of wisdom passed from parents to children about how to handle money in retirement was built on top of that framework. That framework ended. The new one runs in reverse. The advice did not update when the framework did. So here is what you actually do. The first decision is the simplest, and it applies to Gerald directly. If you have a fixed-rate mortgage at any rate below 5.5%, stop accelerating the payoff today. Reset to your minimum contractual payment and do not send $1 above that amount to your lender. The debt is working for you. Let it. Every month you hold that mortgage under a financial repression regime, the real burden of it shrinks. That is not a loophole. That is the arithmetic of the framework. The government is inflating the debt away, and your fixed-rate mortgage rides along with it. The second decision is where to redirect the money you were sending to your lender. Not back into a savings account, not into a money market fund. Both of those instruments are subject to the same nominal rate suppression that is eroding Sandra's bond income. The instruments that protect you are the ones indexed to inflation directly. Series I savings bonds purchased through treasurydirect.gov adjust their interest rate every 6 months based on the official Consumer Price Index. Treasury inflation-protected securities, called TIPS, adjust their principal value on the same schedule. Both are direct obligations of the United States government. Neither can be suppressed below inflation by design, because the inflation adjustment is the instrument. You are not betting against the framework. You are using the framework's own index to stay even with it. The third decision is the one most people delay and should not. Pull every retirement statement you own and calculate the total dollar amount sitting in fixed-rate instruments, savings accounts, CDs, bond funds, any instrument paying a rate that does not move with inflation. That number, whatever it is your exposure. It is the portion of your retirement that the current policy framework is mathematically engineered to erode. You do not need to move it all at once. You need to know what it is. Gerald called my office because something felt wrong. That instinct was correct. The framework does not announce itself. It does not send a letter. It does not show up as a line item on your bank statement. It works quietly, over years, through the difference between two numbers that most people never think to compare. The number your savings account pays you, and the number that measures what your life actually costs. When those two numbers run in the wrong direction long enough, the loss is real, it is permanent, and by the time most people see it clearly, the window to reposition has already closed. That window is open right now. It will not stay open. And the single most protective thing you can do today is know exactly which side of this framework your money is currently sitting on.